look at guys. I have my Thrive pen. Look at it still lights up. The flashlight still works.
Things
Thrive
that
100.
light up are the best, aren't they?
Tom does not have a Thrive pen because he bailed on us, Danielle. So hold that against him.
I have plenty of things that light up in my house, though. If you're not getting educated about local and national real estate market conditions, news, trends, and the direction of the market, you're doing yourself and your client base a disservice. This is the Knowledge Brokers Podcast. I'm Tom Toole here with Lisa Chinatti and Byron Lazine. But more importantly, we've got the chief economist of Realtor.com, Danielle Hale, one of the brightest minds in the industry. Danielle, thanks for coming on. Really appreciate you being here.
Thanks for having me today.
Of course. So we're going to get into the questions we just prepped for. And I know Gary Keller came out and spoke at KW Family Reunion. And I always listen to Gary Keller. I mean, I think he's one of the brighter minds in the business. And he had a very interesting quote. I wanted to get your reaction to this, and then also what you see as some of the economic conditions that may or may not be causing this. So he came out and said it's not getting progressively better right now, obviously talking about the market. And what's interesting is that people keep expecting it to get progressively better. If you go back and look at history, when you get into a trough like this, it typically takes 3 to 4 years to get out of it. So if you were hoping we were kind of going to come on stage today and go, it's all over, it's back, the easy deals are back, that's not true. And my guess is we have at least 2 more years, this year and next year. That's just a guess. And I know we're on track right now to see about the same number of homes sell that we did in 2024. So 1, do you agree with this? And 2, what are some of the economic conditions you see as the cause for this observation by Gary Keller?
Yeah, so I hadn't heard the whole context before. Now that I hear the whole context, I think I agree a little bit more. The headline that was taken, "No more easy deals," I thought I didn't agree as much. But I think there's a lot to value in what he said. Our forecast, Realtor.com's economic forecast, anticipates that sales are going to be up just 1.5% or so. So right around the 4.1 million, a little better than what we saw last year. But, we are not going back to 2021 or 2022 anytime soon. So I do think that context is correct and important. I think we're still going to see home sales. I do think it is going to get a bit better, but it's going to be a slow recovery because you had, such high highs in those years when mortgage rates were so low. And then mortgage rates have now gone up pretty significantly. It's locked a lot of existing homeowners into their homes. So the hurdle or the threshold, if you will, for people wanting to make a change is much higher. It means people are still going to move as life happens. They get married, they separate, they retire, they relocate for new jobs or family changes. But people who are maybe just tired of their house are going to have to, have a higher threshold before they, get into the housing market and try to find a new one. So that's why I think we're going to see a slow recovery. But the longer we're at these high rates, I think the more people will acclimate to them. And you saw that a little bit in the existing home sales data that was out this morning. So we did see a pullback from December to January, not terribly surprising given that mortgage rates shot up in the fall, but January is still up compared to a year ago. So I do think that slow, steady progress, is evident in the data that we've seen so far this year.
Danielle, Lance Lambert, right?
Mm-hmm.
I think you guys know each other. Lance is obviously a big advocate of your work at Realtor.com and sources you guys all the time for the great work that you're doing. He said something on this pod to us, I don't know, maybe a few weeks ago, that most years will just mirror last year, right? So 25 is going to look a lot like 24 with maybe some incremental movement. And so he had an analysis where he went back in time and most years look like the year before. And so maybe in 5 years, it looks like we've gained a lot of home sales, but as we're kind of stepping in that direction, it won't really feel that way. What, do you agree with that analysis?
Yeah, I think that's an interesting perspective. I do think the housing market moves pretty slowly. It's pretty slow to adjust. I took a break from work when I had my kids, and it was always funny to me that when I came back, I hadn't missed too much, really. It's pretty easy to get caught up pretty quickly. So I think there's some truth in that. I mean, that said, at the same time, like we saw during the pandemic, that things can happen that can cause more sudden changes. So while that generally holds true, I don't think it is always the case. And we've been through some really dramatic changes, a fast acceleration and then a pretty hard break in recent years. But I think that's a pretty good takeaway. And it does mirror what we're seeing in our forecast for 2025. We do expect we're going to see some incremental progress over what we had in 2024, but not a whole lot of change this year.
Has that changed since we were at Thrive? I'm trying to remember what the Realtor.com projection was then, because I remember where I placed my wager, and I'm feeling a little less confident on it right now.
Mine might be a little high too. I think I was 4.25. I should have that written down.
Higher. I went 4.31.
Oh wow!
I was 4.25. What did you guess? Can we disclose those?
So I don't
or are those
know.
under NDA?
I don't know if I'm allowed to wager, and so I don't think I submitted a wager. Our official.
And this was what? When did we do Thrive? Was that like October when we were together?
October 24. Yeah.
Okay.
So at the time, we were working on our official forecast that we actually released after Thanksgiving. We release it every year the week after Thanksgiving. So we hadn't finalized it yet, but I can tell you what I would have told you in October was higher than what we actually released, because we did have that change in mortgage rates that started around late September, early October. And that's when mortgage rates really started to shoot up. So I was a bit more optimistic, and we probably would have had a bigger incremental increase in 2025 if we had released a forecast in October versus late November.
Most adjustments to rates since January 1 for, I just saw like JP Morgan's new outlook come out. Most of the updated outlooks are like rates are going to basically be where they're at right now, maybe slightly down at year's end, but still probably above 6 3/4. That's most of what I'm seeing, but tell me what you're seeing on rates in particular.
Interesting. Yeah, I think our projection is that rates will get into the low sixes. So under
the low sixes.
Yeah.
Really?
Wow.
Low sixes as in between 6.25% and 6.5%. So not the very low sixes, but under 6.5%.
Wow.
And is that hold on, let's be clear. Is that where we're going to end the year or the average for the year?
That's where we're going to end the year. So I think the average for the year will be closer to 6.4, 6.5%.
That's still lower than I would have thought.
Too.
Right.
Yeah.
And I will say,
we all predicted higher at the prediction show.
Yeah, I will say that mortgage rates have come in, already higher than we had originally projected for this time of the year. So when we revise,
so how often do you guys update? Like, will you change that number? Or, I mean, obviously you work on this stuff all the time, but throughout the year, will you have different maybe adjustments to that outlook?
We don't usually adjust the published estimate very often. We only do that one like twice a year, but I will often, we'll give like sort of a directional change, right? So that published estimate 6.25 for the end of the year. If I were publishing an estimate today, I would say it's probably going to be a little bit higher than that, which is why I gave you the range of 6.25 to 6.5. But we don't publish the estimate, but that twice a year.
Hey guys, thank you so much for checking out this pod with Danielle Hale. We're going to get you right back to the conversation, but Bobby sent me a stat that blew my mind. Over 40% of you who watch Knowledge Brokers are not subscribed. The best way to support the channel is by subscribing to Knowledge Brokers podcast. Go right down below, hit subscribe and the notification bell. Now enjoy the rest of the conversation with Danielle. And so you still feel like when I look at JP Morgan's outlook, they'll change it, 12 times a year, right?
Right.
So they're going to kind of move whatever way the wind is going in that particular month. Do you still feel confident in below 6.5 or around 6.5 as the average for the year, which means over the next 10 months, we need to see rates really start moving down?
Yeah, I mean, I think, mortgage rates can move pretty quickly, right? From September to now, we're up a whole percentage point. And I think, in forecasts that are issued, there's a lot of recency bias, but that makes sense. If you want to think about where things are going, mortgage rates often move in a random walk. So looking at where we've been is a pretty good indication of where we're going. That said, I do think that the deflationary trend that we have seen is going to get back intact as we get some more data. And so I think that's going to help bring rates down. think there is some uncertainty about the broader macro trends and what the administration's policies mean for the broader macro trends. But even even in recent weeks, we've seen 10-year yields be a little bit less jumpy in response to changes in policy. And so I think investors are kind of settling and looking past some of this volatility. The 10-year yield has been right around 4.5% over the last couple weeks. And I think that will eventually translate into some steadiness for mortgage rates and eventually a decline.
Powell says, he's like, hey, I can't control long-term rates. He made that clear in his testimony, I think, whatever it was, a week or 2 weeks ago, which is true when they're just focused on reducing that overnight federal target interest rate. Okay, that doesn't impact the 10-year and these long-term rates that we're talking about. But since 2009 until really just recently, they were buying all those mortgage-backed securities, meaning the Fed. Mm-hmm. And when they're doing that, that is bringing down the rate. So that is one tool they've used in the past. They're not using it right now. That does have an impact on long-term rates. So what he's saying to Congress is true. Like, what we're doing right now doesn't impact long-term rates. But if they did what they were doing from 2009 to say, whenever they stopped, what is that, 2022, 2023, I guess probably 23, they stopped buying mortgage-backed securities, that would have an impact on long-term rates. Should the Fed start buying mortgage-backed securities to lower long-term rates? Should they not mess with that at all? What are your thoughts on what Powell said to Congress a couple weeks ago?
Yeah, I think, that mortgage-backed securities purchases was in response to the great financial crisis and what was happening in the housing market then. And I think the housing market needed extra support then. So it was
like 15 years of support, right?
Right. Yeah. So it was a good policy move. But I think from an ideal perspective, you wouldn't need to see that kind of support in the housing market. So I do think it is better that the Fed is not in the business of buying financial instruments that benefit certain industries. So yeah, I think it's
why do you think
better.
It continued in like 17, 18, 19, where most of the country felt like it was getting back to, obviously 2020 changed everything, but particularly in 17, 18, 19, when most of the country started to feel more of a normalized real estate market, they continued to buy mortgage-backed securities throughout that time. They had not as high as they were once COVID hit, but they continued to buy from 2009 right through COVID, and then finally stopped when inflation was supposedly transitory than not transitory.
Yeah, that's a good question. And it's not something that I've spent a lot of time looking into. I think, the Fed was probably very focused on just not disrupting, and they like to make gradual changes so that it gives market participants time to adjust. It's easy to look back in hindsight and, have the clarity of like what we know now and thinking, oh, okay, maybe we should have done things differently. But I think at the time, at the time, I don't think it was as clear that the market was as recovered as it now appears to have been in hindsight.
Yeah. And I think some parts of the country felt like it was in full recovery, maybe Sunbelt states where the Northeast was still, from my viewpoint, lagging during those years a little bit.
Yeah.
Well, that brings up an interesting point. There was some Altos research that came out, and they talked about if rates do continue to stay leveled, around that 7% range. I know you're believing they're going to come down. They expect inventory to keep growing and expand. And then there's a question like, will we see some softening on prices, which I know we're seeing in some regional areas. I mean, Byron mentioned Florida earlier, Texas, those sort of things. What do you think about that? Because anytime I see people talking about prices turning negative, personally, because I live in the Northeast, I'm like, well, we need way more housing, but I know it's not the case all over the country. So for a lot of the listeners, what do they need to be doing to deal with these kind of headlines and really educating consumers?
Yeah, I think it really depends on where you are. And this question about price reductions, I think literally yesterday got a YouTube video and this question from my neighbor. So it is on people's minds. I think, it really depends on where you are. We are seeing inventory grow in many parts of the country, but not everywhere. In the Northeast, we are still seeing it lag behind. There's not as much new construction happening in the Northeast. The Midwest is also a little bit laggard when it comes to new construction. We're seeing more building in the South and the West. And so that is making a difference on inventory. And prices are determined by market forces, right? Supply and demand. So if you have supply that outpaces demand, you're likely to see some price softening. And the opposite is true. When the demand outpaces supply, you're going to see prices go up. Our expectation is that prices are likely to go up in 2025, but at a slower pace than we saw in 2024. As we are seeing supply better keep up with demand. But I think your point that you want to look at national numbers to understand the broader context, but what really matters is what's happening in your market. And we are going to see some different trends depending on where people are. Already, when we look at our national numbers, we track inventory more than sales at realtor.com. And what we have found is that prices have essentially already softened when we're looking at listings. And that's because we're seeing more listings that are smaller and in those lower price points and in geographies where real estate is generally more affordable. But when we look at sales data from NAR, for example, sales are more likely to happen at the high end. So we're seeing more growth at the high end. And so that's why, even though NAR's median price is still going up, our median listing price has actually gone down. It went down 2.2% in January. So when we adjust for square footage, home prices are still going up. So some of what we're seeing at the median trend, at least in realtor.com data, is that we've got more smaller and more affordable homes on the market. So that's good for people who are looking for affordability. But if you look at any particular home, in most markets, it is likely to still have gone up. But again, that depends on where you are.
Danielle, I'm curious the script you used on your neighbor. When you said your neighbor asked you about home prices, I kind of lit up there. So your neighbor said what? She said, hey, is our home, where do you live again?
I'm in the DC area.
You're in the DC.
I was right. All right.
All right. So we're going to ask you about
uncertainty right now.
We're going to ask you about all this, this Darth Powell X rant on DC inventory. We'll ask you that in a second. But your neighbor, which in DC uncertainty makes sense, said, where are home prices going? What was your exact response?
What was my exact response? This was a text conversation.
Oh, this is a text conversation.
Yeah.
You weren't out like at the mailbox.
No.
I'm picturing like mailbox, sunny day, but it was probably gray skies, cold text message.
All right, yeah. It was cold. And I was on the road yesterday too. So it was like a long delay before I got back. So I think there are always reasons to be uncertain in the housing market. My advice to them is to keep their eyes open, because I know their context and that they are ready for a bigger place. It's not absolutely essential, but they're ready for it. So my advice is to keep your eyes open. And when you see the home that is a good fit, to go for it. Even someone who is an expert in this, there's a lot of uncertainty in models and no one knows the future with certainty. You can look at trends, you can make educated predictions about what's ahead. And I do think in the DC market, we could see some softness as a result of, the changes in the major employer or a major employer in town.
The major. You had it right the first time. It is the major employer.
But, I think in the long run, the government is not the only employer in DC. There are lots of private companies here. And I think, the factors that draw people to this region, you've got a very educated workforce. I think those are going to continue to make the area healthy from an economic perspective, and therefore the real estate market a pretty good investment.
That's incredible advice, because I think a lot of the people jammed up are the ones that want to move up, because they've got like a lower rate. We know it's 17% of people in the country have a 6 or higher. Everyone else is lower than that. And the house doesn't get bigger, right? Like the kids get bigger. They take up more space. And I think that's the biggest challenge we're seeing locally. And at the same time, there's still opportunities in the market if you keep your eyes peeled. And that's why it's important having someone that can help you with that. And for the knowledge brokers listening, like replay what Danielle said there a couple times, because That's coming from the chief economist at realtor.com. That's not coming from you trying to sell a house. And you can even cite that as a case study. Like, hey, I'm not sure if you're aware of this, but the chief economist at realtor.com had the same advice for her neighbor. And that can help you. You know, you're laughing, but the
That's an
stories go a
amazing
long way.
script. Yeah.
It's a great
And
story.
the script is perfect. And that's the biggest jam up right now. Like the downsizers, they got some money. The first-time buyers don't really care as much about rates. It's the people that want to move up. And that's really the log jam in the market.
And it speaks to, like Danielle said, she was able to contextualize it because she knows this person. You got to know your client's situation. Like, you didn't mention it, but I'm assuming they're committed to the DC area for the next 10 plus years. They have, kids in school or whatever the case may be. So is that the case? They're going to be there for the next 10 plus years?
I think that's the
That's your assumption.
expectation. Yeah.
Yeah. I mean, that's something everybody needs to understand about their clients when they're asking them, like, hey, I'm thinking about waiting for home prices and or rates to come down and then I'll buy. It's like, hey, really the only time when it's not to buy, you can't time the market, but it is time not to buy if you're thinking you're going to move in the next 2, 3, 4 years out of area. Other than that, you start getting 5+ years in a particular area, then that's when it really makes sense to buy, especially if you've got the family and all that. So just on the DC area stuff, do you know that X handle Darth Powell?
I have seen them. I think they like to post on our Twitter handle or X handle. Yeah.
Troll.
It's at Vlad the Inflator. Guy's got a bunch of X, followers, and he'll go back and forth with a bunch of different economists. He's a complete. I think it's a he. I don't know. It could be. It says Vlad the Inflator, so I'll go with he.
It's a he.
It's a complete. Oh yeah, probably lives in a basement too. A complete doom and gloomer about the housing market, and so we wrote an article on nowbam.com talking about his X post. The wildest blank is happening near Washington, D.C. Here's Arlington, Virginia. Everything is being put on the market. And it's just this map with all these homes for sale. He went back and forth with a bunch of your, friends in the industry on X. What's actually happening in D.C.?
Yeah. So, I mean, people are seeing jobs eliminated. So that is very, very real. But we don't see any impact in the real estate data. Might we in the future? Absolutely. But remember, the president has only been in office for a month. So these changes have only rolled out for a month. Right.
Seems like 300.
It does feel like a long time, but it's only been a month. And, even someone who is, maybe planning to sell a home, it's going to take them a couple weeks to a couple months to list a home on the market for sale. So there's no way that we see this impact in the real estate data just yet. And our numbers don't show it. DC's kind of middle in the pack for most of the 50 largest markets that we study. And then the other thing is like, where is someone going to go if they do sell now? I mean, I think we will eventually see it, but I think a lot of people are just going to try to move to other industries. Like I know people who are looking, and no one has asked me about advice about listing their home and when to do it in response to this. Everyone's first thought is, let me see where else I'm going to work.
I mean, the latest headline I saw this morning in the gym was 6,000 IRS employees are on the chopping block. I'm like, good, fantastic. I'm for that, by the way. But they'll just go get a CPA job. Like, just go be a CPA, work in the private market and figure it out. I don't feel bad for the IRS employees at all. Go figure it out. They'll get jobs, create a business, do something. They're all going to figure it out. See, by the way, be a CFO of a company. There's a ton of jobs that are available for somebody who can do accounting. So it's totally fine. There's a couple cuts though that are really potentially going to impact our industry in housing. One of those being HUD. So HUD's got 9,600 employees. That number's, I went to HUD.gov. They had 9,500 employees back in 2007. So they always have had this level of employees. And you think about all the technology, AI now that has presented itself as a useful tool for people since 2007, yet they have the same exact number of employees. So government very slow to change. I think that's what we've really learned over the last 30 days. But they want to make a massive cut to HUD, about 50% of the workforce. Bloomberg reported that would impact FHA. HUD news director saying, no, there's not going to be any impact on FHA loans. And I know you're not probably an expert on HUD, but any analysis on what's going to go on there and how that might impact housing affordability?
Yeah, so I can't speak to the mechanics of like how it will change HUD's operations, but I can say that FHA lending is incredibly important for the housing market. Um, as
Which
part of
HUD doesn't lend that money, to be clear. They
right,
insure it, right?
right, yes,
Okay.
absolutely. So it's lenders that are doing the lending, but then there's the government insurance. It is targeted to make credit more available to first-time homebuyers, low-income homebuyers, minorities, people who have historically been disadvantaged, to help them get a foot in the door, if you will, into the housing market. And it's incredibly important. It also, it enables people to put down lower down payments. So, for a lot of buyers that are on the margin, the down payment is a big hurdle. So it can help, for those who don't have generational housing wealth, it can help them get their foot in the door. So that lending is really important. We do a top markets analysis every year as part of our forecast, where we look at the markets where we expect to see sales and prices go up the most. And this year, a lot of the markets on our top markets list are areas where FHA lending is very common and VA lending, so Veterans Affairs lending, is very common, because those mortgage products are so reliable and they tend to be more common in markets where the pace is a little bit slower. Those markets are expected to be some of our best performers this year, assuming that lending sort of continues in an uninterrupted fashion. And I don't know the details of how these changes might impact that FHA lending, but I can say that it is very important for those borrowers and for those markets where FHA lending is more common.
Do you know what the data is on what percentage of loans completed annually are government backed? Whether it's FHA, VA, USDA, there might be a couple of other smaller programs in there as well.
Yeah, I think it's been a little bit since I've looked at these numbers. I think it's roughly around 10% each for FHA and VA lending. So
Okay.
it's fairly sizable, and obviously it can be
Yeah.
more or less depending on the market. So
Right.
in military towns, like San Antonio, El Paso, other markets where you have big military bases, and then also a lot of veterans who are retired from the military, you see more VA lending, because there's
Yep.
more familiarity with it among the industry as well as among the buyer and seller population.
I mean, just think what that would do. We were talking total sales earlier. You took 10% just FHA out, you're down to
Right.
what, 3.7 million home sales? That'd be existing home sales.
Yeah, yeah. I mean, and no, I don't think that it's going to go away.
No,
But
no,
the question is,
it's
like,
not going
will
to go
it
away.
be disrupted,
Will it
and will it
slow
take
down?
longer
Will
to
it?
get those
Yeah.
loans? And that I don't know. I think it's a good question.
It's interesting because the lending won't be disrupted. It's just insurance. What were you going to say, Lisa?
Oh, I was going to say it's interesting because you said it earlier, in the slower moving markets. Here, it's really tough for us to get FHA loans to go through because it's not as seamless a process as a conventional loan. So, but we do have buyers that rely on those products heavily, especially a lot of our first time buyers. And any slowdown in that could make it even worse.
Yeah, and I
What?
think it's a good. I was talking to someone. So I was in Philadelphia for an event yesterday. I was talking to an agent who asked me about FHA and VA lending, and how do you get sellers to
Hmm.
agree to accept offers from buyers who are trying to use these products. And there is no probably silver bullet answer, but I think just sort of educating sellers about the
Mhm.
fact that they are a significant portion of the market, and that they might create some more complications realistically. Like, I know that VA and FHA have requirements on sellers, but that ultimately these loans often do close. They are a sizable portion of the market. And I think just educating your sellers that it's not impossible to get a deal done with one of these loans.
Tom, did you hear Danielle was in Philly yesterday?
Yeah,
Did you
thanks for
invite her
calling
over
me.
to
I
your
mean,
fancy union club or
Union League, it's a place to be. Let me
or
tell you.
union? You didn't invite her? No.
I didn't know she was here, so there was no invite to be extended. You
Okay.
should have
All
came
right.
on Friday for the parade. It would have been
Oh yeah, I'm sure she wanted to go to that parade with a bunch
Could
of.
have gone to the Union League. It was like the safe zone in the city. It was very, very nice.
Nowhere is safe in that city. Danielle, the other one that's been floated out that would have an impact on loans or potentially, I would think it would have an impact on rates moving higher, would be if they privatize Fannie and Freddie. That's just been floated out there. Obviously, the HUD in the last 30 days seems to be something that might take shape with DOGE efforts. The HUD thing or the Fannie Freddie thing is more of a rumor at this point that they'll want to move that to go private. What it once was private. Would that increase interest rates, and what would that do to really mortgage rates? Yeah.
Yeah. So yeah, it's not a new idea. It came up in the President Trump's first term. It just it didn't actually get done. So I think it's very much going to be on the table. Whether or not it's able to actually get across the finish line is an open question. My expectation is that it would increase mortgage rates. There are different estimates of the benefit of government conservatorship. They range from like a quarter to half a point on mortgage rates. And so rates are between a quarter and half a point lower because of the government guarantee as a result of Fannie and Freddie being in conservatorship. And if they were to go private, we might see mortgage rates go up. At the same time, you also might see more innovation in Fannie and Freddie if they were to be privatized. So that might help offset some of that change. But I think on the campaign trail, President Trump talked a lot about housing affordability and wanting to bring rates down. So I think that the administration will take a thoughtful approach. It's it's generally well expected that privatizing would lead to higher rates. So I think they'll be thoughtful about making any changes there.
Yeah.
So much opportunity to privatize and innovate, as you said. I know the three of us have chatted about so many things that could, help with just creating some portability around the lower aspects that people are locked in with. And I don't know, it would be fun to think about what could happen in that realm, but probably such a long shot.
Yeah,
I do think it's a long shot.
I mean, people have been talking about it for a while. So, I think there are people who have put some thought into how it could be done. I don't think it's the first priority,
right?
But we've got 4 years, and a lot has been done in 30 days. So.
Facts.
So Danielle, you came out with something earlier this week about the January 2025 rental report, and that rent steadied in January, and there's also year-over-year declines. And it's the 18th consecutive month that the median asking rent price across the top 50 metro areas of the U.S. fell on a year-over-year basis.
Tell Powell. Agents, past clients don't exist. Unless, of course, you're retiring in 2025, then consider your clients in the past. But if you're building a business for the future, your clients are your clients. This is where Mosaic comes in, the client experience operating platform for you to manage the client experience. See, cupcakes are cute. It's a nice thing to do, but it won't keep a client tied to you for life. It's not going to bring the value to their home living, home ownership experience for years to come. CRMs work for lead generation, lead capture, and lead communication, while Mosaic helps you transform how you manage those relationships moving forward with the value that they actually need in their home ownership lifespan. So don't wait, check out mosaic.io or find the link down below.
All right. Tell us more about it. I mean, are we getting fake data here? I want to get your reaction to this. I mean, this is the stuff that I think people really need to be paying attention to.
Yeah. So this is market rent data. So this is people that are advertising rentals on Realtor.com. It's a mix of community and MLS-based data. So corporate apartments, but also individuals who are listing their homes for rent. And we have seen rents soften. They've been down for 18 consecutive months, as you noted. I will say, they're not down a ton, just a couple of percent from peak. So we've seen consistent declines, but not huge declines nationwide. And again, it depends on where you are. We've seen more declines in the South than in the West. The Northeast and Midwest have been a little bit more resilient. Some markets are even seeing rents continue to go up. So it does depend on where you are. But in general, rents have been softer. We expect that that's going to translate into the rent metric that Chair Powell tracks that goes into inflation. We have already seen that data slow. It's not all the way back to where it was before the pandemic, but it's come down from a pace of, gaining more than 9% per year. It's down to like 4.5% now. I think it needs to get back into the 3% range. And I think it could do that in 2025. The difference is we're looking at apartments or homes that are being advertised for rent. So they are presumably vacant or experiencing some sort of changeover in the renter. The inflation metric tracks rents for all renters, and landlords, we have separate survey data that show that landlords are more likely to keep rents steady for renewing clients, as opposed to like what, they tend to raise rents more, get to market when they've got a vacant unit. So that's some of the discrepancy that we're seeing. There's still some catch up to be done from renters who maybe saw below market increases during the pandemic. And so we're seeing that sort of that gradual catch up still in the shelter measure, which goes into inflation. So I think Chair Powell is aware of this difference. He's acknowledged it. And that's one of the reasons why they do talk about expecting shelter inflation to go down. It is still a pretty big driver of the overall inflation metric, but it's not the only driver. More recently, we've seen oil prices and food prices pick back up. So I think they're aware of that that trend and have the right perspective on it.
Yeah, he certainly said he's aware of it. But he continues to say that he's just not sure when it will show up in the data, although he expects it to start showing up in the data. If you were going to trust just one source, owner's equivalent rent or your own rental analysis of real time, and you were going to make the way we look at it, inflation more efficient, which one of those two sources would you go with?
Yeah, I mean, I think they're just measuring different things, right? Like we have
one's measuring reality and one's measuring guesses by consumers.
Well, I mean, yeah.
It's a Washington, D.C. answer if I ever heard
No. So the owner's equivalent rent is not just guesses by renters. They're looking at market rents. And what they're doing is they're adjusting for the fact that what's available for rent is different than what the owner's equivalent rent, for instance. You've got different types of properties and different markets and that sort of thing. So it's more than just an educated guess from consumers.
Like, I don't want to ask a consumer. I want to ask Danielle Hale, the expert, what's going on with rents.
Yeah, I think you do need to track market rents. And I will say, it's been a little while, but even at the BLS, and that's the group that puts together the Consumer Price Index, that
Bureau
inflation
of Labor
data.
Statistics.
Mm-hmm. Yep.
Which I'm curious why Bureau of Labor Statistics puts that data together. But if you have an answer on that,
I don't know that I do
Nobody
know
knows.
That.
Nobody knows, but go ahead.
But I can say, they are aware of different market rents, and we've had conversations with them about what goes into our rent metrics. So I think they are aware of those market rents. They, I think, are often thinking about like what they can do to improve their metrics. So,
because if we had an improved metric that's more 2025, not like a model that was built in the 80s, we might be able to better understand that, inflation is coming down. Like even when some of these hot reports we had the last month, and there's a lot of people that are dissecting it, saying it's really not as bad as some of these headlines are reading in terms of inflation. So we can better understand that inflation truly is coming down. We could get ahead of it in a way, unlike when the Fed thought inflation was transitory, and it certainly wasn't. And they convinced Congress to go print an extra $2.3 trillion that we didn't need to print. And they just blasted more liquidity into the market. And that actually accelerated inflation. So I think if we had our timing better overall in the middle of bad timing by Powell convincing Congress to spend $2.3 trillion, and maybe bad timing right now, not understanding where inflation is in the middle, I think Powell's done a good job weathering the storm. But on the ends, we might have avoided some of this if we better understood the data that is coming in?
I think in this case, it's not just about the inflation data, but it's also about the fact that the labor market has not only been relatively solid, but after hitting 4.3% back in late 2024, we're back to 4% for an unemployment rate. So that suggests there is more underlying strength in the economy than I would have expected with rates as high as they are. So I think they're trying to balance both of those considerations. And at least right now, they're both kind of lining up to say, maybe we don't need additional rate reductions right at this moment because inflation is not relenting as much as it had been, and because the unemployment rate has actually moved lower.
Do you buy into this theory from Elon that if we eliminated the $2 trillion deficit, that inflation would go away? Byron talked about this and how Jerome Powell and Elon were talking about why rates were elevated. I'd love to get your interpretation of that.
Yeah, so I mean, we talked about how it's not the Fed's rate that matters, right? It's the 10-year Treasury rate that
Of course,
is more important. So those longer term rates. And it is true that when people are buying 10-year yields, they're not just looking at the economy and their odds of being repaid today. They're trying to think long term over the next 10 years. And when you have sizable government deficits and an already very large amount of government debt outstanding, at some point, investors might start to get worried about their ability to be repaid. And so that could be a factor that's contributing to higher rates. I think getting the fiscal house in order should, in theory, help bring down rates, give investors more confidence that they don't want to put as much of a risk premium, on the rate or the yield that they're expecting when they invest in government bonds. And so, I think that would be a good thing.
I think it would be a great thing. And then I think Elon said something this week that was actually would have the opposite effect. It was quite dumb. Was floated out a $5,000 dividend on this savings. So like originally when I heard it 2 weeks ago, it's like, hey, we need to cut waste out of government to reduce this $2 trillion debt. Long-term, inflation stops, long-term rates comes down. That math makes sense. But then sending a 5,000, like a 20% of this money back to America, you give somebody $5,000. What are they going to do? The same thing they did during COVID. They're going to go buy a skateboard or a dirt bike or a table at a club or, sushi or something. I don't know. They're just going to spend it on crap. Sushi. And it's just going to run. We're going to run into the same problem.
Byron, do you not like sushi?
I love sushi.
Byron doesn't like a lot of things.
No, I like it. I don't skateboard or dirt bike.
People would be number one. That would be number one.
Dogs would be number two.
Yeah,
I do like sushi. It's gone up quite a bit lately.
Yeah. I mean, I think when fiscal policy does matter. And when you issue refund checks, dividend checks, whatever you want to call it, when you issue money to people, then they do tend to spend it. Right now, the economy doesn't look like it's in a place where, people need that sort of fiscal stimulus. Like the unemployment rate is low. I think the economy is healthy. I don't know that I think that that's necessary. And you could actually bring debt down more if you use that money for savings rather than necessarily trying to stimulate the economy.
Like just stay on the mission. Bring the debt down and then start working on bringing my federal taxes down. Those two things. That's what I'm in the camp of. And if you brought at the least, if you brought debt down, it would, and you agree, have an impact on reducing inflation, and then the long-term rates would follow there. You could.
I don't know that it would
the dots.
Yeah, I don't know that it would necessarily have an impact on inflation, but I think it would reduce the amount of yield that investors expect to get or require to get, because it reduces the riskiness of that debt. The
long-term rates,
there is, the more likely they are to be paid back.
Well, I think on inflation, though, as you cut out this government spending, there's $2 trillion going. Some of the money that's going around, it's like going into what? That is an inflationary measure, so it can maybe impact both sides. $2 trillion out of the economy into just, I know most of this money probably gets spent over in London or something. These fancy people, take planes out of your airport and go to London and spend that money over there. But
I don't know that
Some of the $2 trillion is getting spent
I
here.
don't know that I would say like government workers are fancy. I don't know that that's a fair characterization. Given what I
Right.
know, I don't think so.
Not the average one,
Right.
right?
Yeah.
Yeah, I'd probably agree with that. All right, Danielle, what is Realtor.com thinking about? Any messages you want to deliver? Nothing directly from Damien. We don't need to hear from
Oh,
Damien.
I mean, I'm not going to speak for Damien. Damien speaks for himself for sure.
There you go. What are we going to hear from you as a final thought here?
As a final thought here, look, 2025, I do think from an agent's perspective, it's going to be a challenging market, but I do think it is going to start to get better. I do think, as always, knowledge is going to be important. You want to make sure that you are armed with the best stats because your clients are going to want to know. And it's important to understand the national context, but also how your market fits within that national context, especially this year where we're seeing different trends in the Northeast and the Midwest versus the South and the West. If people aren't aware, we've got a real estate website, realtor.com/research, where my team puts up all of our insights.
That's a good one.
So
It's
Great one.
fantastic.
Thank you. And I mean, if you've got feedback or suggestions, it's good. We're always trying to make it better. So we'd be happy to hear those.
We'll link it down below too. Bobby will put a link in so everybody can go check it out and go play around with the realtors affordability. Would you call that like a heat map? That's what I would call it, a heat map. Or
Yeah, it's a distribution that we do. It looks at affordability. That's an interesting one, not just for the median household, but across the income spectrum. So low income, high income, and depending on which slice of the income pool you're looking at, you'll get a different picture.
Yeah, and it might be useful in helping people figure out where they can fit into home ownership in your local market, because it breaks down all these different markets across the country. So I love what you guys are doing. Danielle, I every time I get a chance to chat with you, I really appreciate it, because you share a lot of great insights and different ways of thinking, and that script that you dropped on everybody should be on repeat.
I was gonna say, I've got another one about hesitating to buy and then later regretting that decision, but we'll have to save that for another podcast.
We got 2
that's
minutes.
like
We got 2 minutes.
No,
you can't hold out on us.
Let's get for
No,
everyone
so,
that
like,
stayed this late in the pod. This is the
bonus.
hidden nugget.
The bonus. So in 2019, I don't know if you remember back to 2019, people were talking then about whether housing was in a bubble, right? Do you remember that? I mean, look back now and you think, oh my gosh, what a deal, right? I bought a house in 2019 because I was expecting twins, and we no longer fit in our 2-bedroom condo because I already have an older son. And at the time, I remember talking to several other housing economists who were in similar positions, but didn't need to trade up as urgently as I did. And as I recall, neither one of them moved at that time because they just weren't sure about the housing market. And in hindsight, oh my gosh, I'm so glad that we bought in 2019. So all that to say, hesitating is also, a decision, and it might not always be the right one.
It's so true, because when we walked into 2020, before obviously middle of March changed everything, there was, February, there was a lot of multiple offer situations going on in February, right?
Mhm.
Obviously middle of March put things on pause, and then it picked back up, but it was ramping up to be a spring market that was going to be ultra competitive. It was going to push prices up in that spring market in a lot of parts of the country. And so, yeah, people were talking about that. Is it going to be an overheated market? And there was so much more to go. Obviously, going back to some of the government talk, we printed so much damn money. So that's
Tell us how you really feel.
kind of goes line in line there. But anyways, all right, Danielle, not to make you feel too uncomfortable. Thank you so much.
Thanks for having me. It's good to talk to
Great
you guys.
pod.
You'll be back this year before the end of the year?
Sure. Yeah.
All right. And where are we going to see? Where's Thrive? Where's Thrive going to be?
Oh, I do not know.
Oh,
They
geez.
tell me, and I don't know yet. I'm sorry.
You know, Lisa? Do we know?
No, I don't know. No.
Now, Lisa's already got it pre-booked. They've gotten her the princess suite in the hotel.
They're still bitter, Danielle. They're still bitter. I'm going to find out now, and I'm going to call
Lisa, I didn't even
ahead.
go.
We
I think
need
it's
to
going
know.
to be out west. That's what I think.
Yeah,
we kind of bounce
'cause it
back
was
and forth.
east.
So yeah.
Yeah, I agree. All right, Danielle, thank you.
Yeah. Thank you.
Thanks, Danielle.
Thank you so much for checking out this week's Knowledge Brokers podcast. If you want to take what we're doing here at BAM and use it in your own business, join us over at School. We just switched BAMX into the #1 education and community platform. Go to school.com/BAMX or hit the link in the description, school.com/BAMX. I'll see you in the community.